Over the years, we've talked a lot about how simple trading can really be. And this does not really translate to easy, but simple still works in trading. And it's not just a play on words, but it really hammers home that the work that you do to find trades and manage your risk and other variables that make up the act of trading is pretty simple. But doing it consistently is really another matter. And that's when not easy comes into play. And a trading method, really, it's only part of the battle. And I want to focus on the term simple by using the US dollar Canadian dollar pair to highlight the following points. A simple pattern, a simple entry, a simple risk reduction, and a simple exit from a trade. And for this example, we're going to keep the context in mind. So when we talk about this, I want you to keep in mind that it's a steady uptrend in the US dollar Canadian dollar. It's 2 weeks in January of large momentum moves and 10 weeks of the market in a pause. Okay, that's just the context in general. Now, a simple channel here is drawn on a daily chart once the lows and the highs are locked in, and it could be used for anchoring and duplicating the lines. Now, there's nothing magical about channels, but they do tend to highlight the rhythm of the price action pretty well. And an interesting time is when the channel is broken with momentum. And those can offer some really solid trading opportunities if you know how to trade them. Channels can highlight trading ranges, trends, and even pullbacks. And it's a simple tool with many uses. And to keep it even more simple, I just really consider any type of channel a volatility compression or consolidation. This channel here, it shows more of a range in the action of the price with a slight upward slope. And I think we can agree that the price action is making some pretty sloppy moves inside the channel. Nothing is really clear cut. And it's showing that neither side is willing to push price in a direction which indicates a rough agreement on the current price range. So in hindsight, sure, you can sell the top as we see in the middle of the chart, but unless you're day trading on lower time frames, this price action is not conducive to a clear trading opportunity, for me anyways. Now, there was a clear setup, and it's shown here with the orange circle, and I certainly could have moved my line so the shadow broke it, but consistency matters in trading, and I missed the trade. And for me, with my setup, that was not a trade entry. The green circle, though, that's an entirely different story. It's a reversal type of candle, of course, but the highlight for me was that it probed below the bottom channel and was quickly rejected. So did it trigger sell orders and then quickly reject them, forcing traders to buy to exit and help form a strong bull body candle? Well, the details behind the scenes was not as important, but this failure test was an entry for me into a long trade. Now, here's a tip. You don't really need to know the reason behind everything that happens. There are so many variables at play on any chart at any one time. And as a matter of fact, I did not wait to close the daily candle, which was called front running, because location, context, and sharp rejection was enough for me to take a risk on this trade. Now, the stop was below the low of the entry candle, and I find setting stops on these types of plays pretty straightforward. Mean reversion trades are another matter because you're setting your stops on those setups come with their own set of issues. And one of those issues is that pullbacks are angular, which can present a problem with a defined placement of your stop using price. So you may want to experiment with using like an ATR type of stop with pullbacks once momentum starts to move the price in your direction. So one easy way to cut risk is to take trading profits at 1 hour. In these range plays, I usually cut half of the position off, which will leave me with no risk on the trade. And you can see on this chart where my position size was reduced. Risk reduction and management is critical for your long-term trading success. And you really want to understand your winning streaks, your losing streaks, along with your probable losing runs. So what had me trigger into this trade was an obvious reversal candle at a prime location in a market that wasn't an uptrend. What gets me out of this trade is an obvious reversal candle that shows up in the middle of the range, and it's a range that has seen some pretty sloppy price action. So the candle that gave me my risk reduction also closes as a candle with a small bear body and a long upper shadow as pointed in the trading chart here. It's impossible to ignore that candle, and my stop was ramped up to just below the low. And you can see that I was just taking out this position, which left me flat with 134 pips on the scale and 53 on the profit stop. Now, there are clues on charts, but not every clue really builds a big case to base a trade on. Not every move is playable, but at a certain point on a chart, there is the possibility of the supply and demand imbalance being big enough to give us a playable move. Simple price patterns that have been around since there have been price charts, showing up at certain points in a market, can really offer the astute trader plays that are really worth risking some of their bankroll on. So it doesn't have to be complicated. You're not reinventing the wheel here. It's just using simple trading tools or indicators, what has shown to give a slight edge, and just getting the most out of it until the time comes to exit. And then you just allow compounding to help grow your account. Now, since many traders like to use indicators, usually the wrong way, for their trading method, Netpicks has put together a free and vital indicator blueprint to put you on the right track when using an indicator for your trading decision. And you can get access to the PDF and the videos by clicking here.